Hello and welcome to the FinTech Finance Virtuarena. I'm your host Doug Mackenzie, and on today's session we're going to be looking at how BNY Mellon are utilising blockchain to digitise working capital in the global trade finance scene. And joining me today is June Kim from BNY Mellon. June, how are you doing today?
Great, thanks for having me, Doug. So great to be here. Good to meet you as well.
It's our pleasure to have you on because I'm absolutely fascinated to, it's obviously such a big buzzword, and I think we're actually going to really cut through some of that and land on something really interesting. So June, thank you again. Now, for our audience who might not be aware, I know we've had you on a Virtuarena before, June, but could you detail us a bit more about your role at BNY Mellon, please?
Great. Name is June Kim. I currently manage the global trade finance product and portfolio management for treasury services at BNY Mellon. So I began my 6th year at BNY Mellon. Prior to that, I was with a number of banks. And the trade finance is one of the critical areas that we're trying to grow for our servicing our clients. So this is what I manage currently, and I look forward to having a robust discussion right now.
Yeah, well, I think that you've hit the nail on the head. I mean, it's going to go through so much changes, but before we kind of dive into that robust discussion, I think we need to kind of outline where the state of the industry is now and where it was before. So June, for a bit of background, what was the state of digital payments and trade finance pre-COVID-19?
Yeah, so I think everybody who has been within the trade finance industry recognizes the fact that the trade finance has been in one of these areas where it's fairly manual intensive and requires a lot of original documentation. So what that means is the development of the digitization in the trade finance space has been somewhat limited. It's not because I don't think the industry wanted to, the industry did not want to transform into a more of a digitization state, but the rules and the guidelines makes it very difficult to digitize to a certain extent. So if you think about an importer and exporter relationship, essentially that's what the trade finance is all about. So the question is, how do you make the settlement of the trade transactions? And typically what will happen is, so let's say, take an example, Doug. I'm selling you something and you don't really know me, right? So would you take some sort of a digital copy that I show you a proof of a goods that I've shipped the goods, and based on that, would you be comfortable enough to make that payment? Probably not, because you want to see some degree of an original documents that I can show and illustrate the proof of the actual shipments and etc. So based on that typically implies original documents are needed. Yeah. So original documentation is really a critical component. But as a result of the pandemic, where many people were working from home, didn't have access to the office, it became really, really important for many of the banks as well as the counterparties involved that in order to complete those transactions, digitization of certain documents have become really, really important. And I think this is as a result of the pandemic. I think the overall industry has begun the importance as well as the urgency to digitize, because digitization does a couple of things. If you do it right, it creates a certain validity that the transactions, as long as you use the right technology, that the shipments and the settlement of trade can happen quicker with a better security and risk and monitoring. At the same time, it will enhance the overall client experience rather than, so if it took a number of days, X amount of days to settle certain trade transactions, as a result of digitization, you can actually process the transactions quicker So I do think that the digitization becomes really an important priority for the industry, and I think many of the banks as well as the regulatory agencies, trade organizations such as ICC and the BAFs are really working to see how we can streamline the process, moving away from paper to digital.
I think that's so important. You have to have the whole ecosystem moving towards digitization, because one element that becomes digitized, if the rest of the chain isn't, then there's almost no point. And especially an industry that is so well regulated as trade finance, and one that requires so much communication between all parties, that ecosystem must be complete. Now, those are some incredible points, and in terms of how that is now changing, that's really exciting. But I want to focus more on you guys at BNY Mellon, because you've been a key factor in that movement, that push. So can you tell me a bit more, and this is going on from digitization a bit further, can you tell me about your work to introduce blockchain technology into international trade finance, into that digitization process?
So I think the blockchain component is critical in the trade finance world. If I can put it into a simple context, right now, although we talked a little bit about original documents versus digitized documents, but yet at the same time, digitized documents versus an original, depending on how you think about it. If you have bad actors, they can potentially manipulate both of those areas, right?
Wow.
So the blockchain component becomes really, really critical in the trade finance world for the following reasons. So the journey is taking place. We still have ways to go. But perhaps what I can do is provide you a little bit of an illustration of how blockchain can help, right?
Please.
So if you look at some of the typical trade transactions that you do, let's think about that, right? So Doug and I decide to make a trade transaction, yet at the same time, you come in. Let's assume for a second that Doug, you are the banker, right? So I am the borrower, and you want to lend me money, and you want to assess what kind of collateral that I have, right? So let's say I have a collateral in my inventory that's worth $100.
Yeah.
And against that collateral, you want to lend me, say, $90 and $80. And you have that collateral associated with it in case I default on that particular loan, right? So that's the typical structure. But yet at the same time, there is a potential possibility that you may, I may utilize that collateral to multiple banks. So I end up going to Doug 1, Doug 2, Doug 3. And as long as the Doug 2s and the Doug 3s are not aware of the fact that you already have, Doug 1 has access to the collateral, they will lend me the exact same amount. So within that one collateral, it's potentially possible that Doug 1 and Doug 2 and Doug 3 gave me $80. So I ended up having $240 of a loan against the $100 of collateral that you assess. So this is what we call typically using bad actors to use a collateral or different types of an instrument to create double, triple, quadruple financing. So there has been a number of scandals over the last few years of a certain warehouse financing scandal in China, as well as a trading company in Singapore, where they have decided to create this massive amount of multiple financing. So what blockchain can do is essentially, the technology will say, when Doug has lent me money for $80 against that $100 collateral, that every other banks who have that relationship with myself would have a full visibility that this particular inventory of the collateral that Doug has financed is already assigned to you, so that they do realize that there is cannot create another financing against that collateral. So that's really the concept of where the technology comes in. Today, without the blockchain or the technology, it's almost impossible to really truly figure out as to which banks have created types of a financing that could potentially result in the types of scandals that we have faced in the past. So I wanted to give you that little bit of an illustration from a simple example perspective.
It illustrates the point perfectly, because suddenly you can just see that so much risk is taken out of an industry that is plagued by these kind of almost leaps of faith, if I want to say, in a way, but being able to mitigate that risk is pretty much the bread and butter of every bank. And to be able to employ that technology is going to be so critical going forward, now that we've had trade routes, trade finance being disrupted so hard. To be able to take away a little bit of that risk sounds absolutely incredible. Now, with that in mind then, you guys have worked with the Marco Polo network, and can you tell our audience a bit more about that network itself and what it means for BNY Mellon?
Yeah, so the Marco Polo network, I think it's a very important initiative in the trade finance, particularly related to the payables and the receivable financing, where approximately 85% of the world trade is being settled under the open account. So, if you think about it, the world of trade is settled in two means, right? One is what we call traditional trade, which is the using the letters of credit as an instrument to settle trade transactions. Okay. Versus everything else is what we call an open account. So you don't involve a letter of credit. You buy and sell based on the contract that you have between an importer and an exporter. So unlike the traditional trade where ICC has come up with the UCP 600, where you have general rules and guidelines about how you to handle a letter of credit, open account or supply chain financing and receivable financing instruments are somewhat depending on how you set the agreement on a bilateral basis. So what Doug and June does may be different from what Doug 1 does with the June 1. So depending on how you sort of classify what that is, it creates a level of a variation. So you've seen that to a certain extent. You've seen a most recent scandal regarding a well-known name, a supply chain financing arranger, which filed for an insolvency as a result of the types of transactions that they were involved with. So essentially, they were involved in providing a working capital, but they were classifying that as a supply chain financing. So people have a different set of rules in terms of what is a classic open account supply chain financing. So what Marco Polo Consortium does is it's a network. So if you think about a traditional letters of credit, people exchange messaging through the SWIFT, right? So you receive and it's authenticated. So you have a network that creates that messaging, whether you're sending or versus receive. Open account, it's basically done on a bilateral basis. Bank to a buyer, I'm going to create a financing for you. Let's make a separate arrangement. So this is how we're going to create the financing. And the other banks may have a different set of rules and guidelines. So what Marco Polo, along with there are a number of different fintechs that's creating this type of a network, is to create more of a standardized rules and understanding of what kind of payable financing, what kind of receivable financing, and they clearly define the rules and the definitions of what should be classified under this type of a definition. So having a consortium banks come in, so one of the example that I gave was Doug to June is different from Doug 1 to June 1. So what that does is creating a consortium will allow the banks to be who are in the part of the consortium to understand what I'm doing with you is also aligned with what June 1 does to Doug 1. So it creates a much more of a standardization in terms of clearly identifying the definition of payables and the receivables. And I think in the long run is having this type of a network for an open account space, essentially similar to what SWIFT does for the traditional trade, will allow all the banks who are engaged in this open account financing transactions to have a much more of a robust understanding and the rules and alignment and the guidelines as to what you can execute so that we can essentially minimize and avoid some of the bad things that we just talked about 5 minutes ago in terms of the double financing and fraudulent transactions.
Well, I think this is coming at a time in finance that we're witnessing this across so many different channels within banking, and that's increased collaboration, but more importantly, increased communication between various institutions. That obviously there's been a lot of communication between banks before when it comes to reducing risk, but now we're seeing it on levels like this. It's going to open the door for reducing risk across all the board, but hopefully enabling innovations as more and more organizations are talking. Now, we've talked about reducing risk, we've talked about the increased communication that it affords. Now let's talk about what this can do for environmental, social and governance finance as well. I'm really interested, for such a global vertical within finance, what is this new technology, I want to call it effectively, even though it's just being implemented really, what's this going to bring for ESG finance?
So I think ESG is absolutely important from many aspects, right? So how we sort of think about part of the reason as to why Marco Polo was one of the core partners that we wanted to work with is the types of transactions the counterparties are involved in. So ESG can be a number of different things, right? Eco-friendly to child labor. You have different types of a scorecard system.
Right.
So while we continue to service critical clients, right? So if you think about an oil deal or some sort of a coal deal, there are essential goods that has to be needed in certain countries, and the banks will continue to facilitate. Yet at the same time, we want to identify the counterparties who are more geared towards putting the ESG as a priority, and then creating the policies around that to see how we can create a more of a better, call it a world in the future for our children and next generations. So what some of the key functionalities that the fintech, including Marco Polo, what they're generating is being able to create a risk rating assessment of all the counterparties involved as to how ESG friendly they are. So this is not about getting away from a non-ESG type of a clients, but we're going to create overall solutions. The world of trade requires different types of commodities that's involved too, so that the world can exist. But the idea here is to having that capability of understanding what the counterparties are doing from the ESG rating perspective, will allow us to create potentially a more of an incentive and motivations to these clients to say, this is exactly how what you're doing is aligning with our overall ESG policy, so that we can create perhaps potentially a better incentive and motivation to put that as a VIP client or more of a prioritized client base so that we can do more with them. So that's really the concept of where ESG is going. And I think having to identify, so let me backtrack a little bit. So ESG itself is today, everybody knows the importance, right? Right, but how do you actually execute that type of concept and principle and into
How
the
do you add
next
value
level.
to it?
Exactly. So this is where the technology comes in for us to assess the counterparties involved as to the various different variables that we will analyze in terms of what each of these counterparties are doing from the ESG rating perspective, so that we can create a different type of a model to service those clients more in a eco-friendly manner or ESG-friendly manner, right?
I think that sounds absolutely amazing, June, and I'm really impressed with the work you guys are doing with that, because it's, as you said, it's creating incentive to effectively just highlight the good that people are working with, and then to go on and become those VIP collaborators and people you work with. That incentive is the most powerful thing to do, and I think that's absolutely amazing.
That type of a methodology is critical, right? So right now, generic questions about how are you assessing your ESG policy, but more of a concrete variables or methodologies that we can share amongst the communities or within the industry. So that will allow us to sort of speed up the ESG initiatives a little quicker than just thinking about it from a social responsibility perspective. And I think the time has come for us to start executing some of these things rather than thinking about it in a holistic manner.
I can't agree more, and to be able to hear a use case like that is very refreshing for me. It's very exciting to actually know that the wheels are being put in motion in probably one of the most important aspects for of finance that ESG should be involved in. And I mean, I was going to throw in a question asking about all the work you guys have been doing when it comes to digitizing payments, but that really has been what the whole conversation has been about, June. So I'm going to wrap it up here, because honestly, I've been so impressed with your guys' work to digitize trade finance, and it really shows throughout the whole value chain that it's a key and core principle. So June, I've got to say a massive thank you. And also I'm going to say a massive thank you to our viewers as well. Thank you so much for watching. You can obviously catch the rest of the series and much more over at ffnews.com, and of course YouTube, and especially LinkedIn, where you'll see me in your comments. So June, once again, thank you very much for your insights. It's been an absolute pleasure. I hope you've had a lovely time, and goodbye.